Welcome everyone to the third Arcan Capital fireside chat. With you again, Steve O'Brien, CEO of Arcan Capital, and Andrew Lorber, partner at Arcan Capital.
Good to be back, Steve.
Yes, absolutely.
So just as a reminder, this is a short format podcast, right? It's meant to be listened to when I always go back to my doing the dishes, but it really is kind of how I think about it. Doing the dishes, on your commute, whenever you've got a little bit of time. We've experimented a little bit with timing. So our first one was shorter. Our second one's a little bit longer. I think we've realized that sweet spot is kind of that 20 to 24 minute range. That's where we're going to aim to keep this discussion today. But I'm really scintillated about our topic. So do you want to kick us off, Steve?
Yeah, absolutely. I think we want to remind everybody, our first two episodes, we were really getting our legs beneath us. We'd never done a podcast, chat, anything like this before. Wanted to make sure that there was a good reception, that people were interested in it. And I think we've gotten a very positive reception. So we're going to keep doing this. And we are going to try and keep it into that, at least the range right now, around the sitcom length, 22 to 25 minutes of time. And today we're really going to dig into where we are in the current cycle. Like I said, we sort of worked our way up with some old material that I think a lot of people either knew or we dug back into. And now we're getting into what is really going on today. And as a part of that, we want, this is going to be a multi-part because what's going on today is really complicated. It's brand new and
constantly changing, right?
And constantly changing. So our hope is as we start to talk over multi-parts about what's happening today, we can dig in and tell you more about what is going on and what's changing. And it can be an ongoing series that there'll be a reason to pick up and listen to every couple of weeks or every month as we record these. So without further ado, we're going to talk today about the players today. And what we mean by the players are those involved in the market today. So we're talking about operators, the people that own and buy the assets. We're talking about investors, the people that fund the assets. And we're talking about lenders, which are the people that give you money to go buy the assets from a loan perspective. And in our business, that's almost every deal has a loan on it.
That's right. So I think it's helpful a little bit for us to recap kind of our last two episodes, because again, they really set the table for where we are today. So just briefly, we covered that period post-crash up until about 2023 from a chronological perspective. Now, again, to your point, we're talking about what's happening today. But again, what brought us to this? People bought deals at the peak. We thought the peak was going to be in 19. It turned out it was really in 22. And there were a lot of people buying through that period of 19 through 22. A lot of them used floating rate debt. They didn't use fixed rate debt. And that is very germane to what we're going to have a conversation about today.
And that's the mistake that was made, right?
That's the big mistake that was made.
Why did they use floating rate debt? Bridge always has a place, but they used the floating rate debt because they couldn't make the deals work with the fixed rate agency debt. So they got
and when you say bridge debt, Steve means floating rate debt, usually at a higher LTV. If a deal has got some physical issues that need to be taken care of, it doesn't qualify for traditional financing. That's
shorter terms,
which
is what we're going to get to today. Is 3-year loans versus 5, 7, 10-year loans.
Right. So you had a lot of players take out this floating rate bridge debt. Rates went up, right, as the Fed raised rates, and the 10-year and the 5-year all sold, all the government bonds for that matter, sold off. So if it went way up, right, which is obviously how a lot of the floating rate debt is priced, which we discussed in previous episodes. We want to discuss, how the impact on operations. That, obviously everything got more expensive when inflation hit. We talked about, profit margins last time as well on properties have come down over the last few years. And as a result, a lot of deals are no longer working. Their interest payments are much higher. Their operating margins are much thinner. And so you're at this place where a lot of deals aren't working. Yeah. So that sets up for where we are today.
Here we are today. And so the first group we're going to talk about are the operators, selfishly, because that's what we are.
That's right.
We are investors. We do invest in our deals and other deals.
The only thing that we're not on this is the lender on this capital.
Yeah, we are not.
Steve and I, in our personal capacity, we actually have done a couple of lending deals.
Yeah, we may not do any more.
We'll touch those in a little bit.
But we are first and foremost operators. And so what does that mean? We are finding the deals. We are operating the deals. And in our instance, we are property managing the deals. A lot of operators don't manage. They will go acquire a deal and hire someone like Arcan or even a much bigger property manager to come in and manage the property. What's the difference between the two? It's hard to really say. At some point, you're acting like an owner, and at some point, you're acting like a property manager. And it's very difficult to tell the difference between the two at some level. But by and large, what's happening on site, collecting a rents, signing the leases, fixing the actual HVAC system that breaks. That's really what you're talking about for
Managing
property
your
management.
occupancy to some
Managing
degree.
your occupancy.
Yeah.
Right. Strategically, though, what you're buying, when you're financing, how you're accomplishing it, when to sell, that's really what you consider an ownership duty. But operators can cover soup to nuts.
They absolutely
thing,
can,
as
right?
we do.
Well, I mean, we're vertically integrated, so we
Right.
do everything from the ownership to the asset management, to the property management itself. And I think of that as kind of you've got grand strategy, and tactical, and we cover all three verticals.
Yeah, the operators are also the ones who get blamed.
Absolutely, and to be fair, they probably should.
When things go really well, they make more of the money.
That's right.
They get to promote, they get a higher percentage of the waterfall when things go really, really well. So when things go badly, they're the ones in charge. For lack of a better term, the operators are running the business, right?
Absolutely. Well, that's the whole point. They're operating the business, and
yeah.
I think it's been lost in this cycle that real estate is an operating business.
It is. Well, and even within real estate, you have different levels, and we consider multifamily, along with hotels, to be the most operating intensive business. You could have the best located apartment and the best located hotel, and if you've got the wrong group running it, you're not going to be very successful. You are going to probably struggle, unless it's 2010 to 2014, where it doesn't matter what you buy.
I was going to say, right? if asset prices are crashing, then it doesn't matter how well they're operating, right?
So it's the whole piece of the pie together, right? And I think what we think is going on right now, you're seeing, as deals start to go bad, operators start to look bad. When they were the bells of the ball in 19 and 20 and 21, everybody thought they were geniuses. And
they were making a lot of people a lot of money.
Making everybody a lot of money. And what you find is, the cream really rises to the top when the market changes and the cycle ends. And so I think that's what we're seeing. So what does that look like again? What that looks like for most operators is, unlike 2008, for instance, which we talked about previously. In 2008, everything was a disaster. It was really bad. And so there didn't seem to be quite the penalty for non-performance. There was, because financially there were massive.
Well, it's one thing, right? I mean, when everybody's losing money, it's hard to penalize somebody for losing money. Right.
And this time around, the reality is, yes, there are some groups that we are not going to mention, but we will discuss, that almost every deal went bad, their company went under, and that does happen, and that happens all the time. Now, it's happening a lot more now than it happened in 21.
Well, when the tide recedes, there are a lot of things left on the beach.
And there were a lot of big, very successful companies that happened, and the portfolios are still being figured out. Lenders and everyone's still working on it. So you do have some of that going on, yes. But I'd say the majority of what's going on right now is people who never had a deal go bad are starting to have a couple deals go bad.
That's right. And it's a percentage of a portfolio too, right? So I think, this is one of those things that I think transcends the quality of operator. I think there are bad operators out there that have had a couple deals go bad, and there are some great operators out there that we respect immensely who've had one or two deals go bad. Even though if you look at, the portfolio and their body of work, they've done 30, 40, 50 deals, they have two that are in trouble, and they're getting blamed for those two deals. Now, I understand why, right? They need to take responsibility for that. But the truth of the matter is, I think, as we can sit here and tell you, even the best operators will have a bad deal from time to time.
Yeah, we've had a deal go bad before.
That's right.
And I think what we're really talking about is trying to set up, for Arcan at least, trying to set it up so that when a deal doesn't go as planned, there's still an exit strategy, right? And so what we're finding right now is, even if, take a good operator out there that bought 10 deals, and I think this is most of what we're seeing. So you got a good operator, they have 10 deals. One of the deals is a mess. They're worried they're going to lose everything. Another couple of deals, maybe there's a capital call.
Yeah.
Maybe they're thinking, I just got to get to 2028. I just got to get to 2029. And we're seeing a lot of that. Now, some of that is a fool's errand. Some of it is you're toast, you're out. Probably let the lender take it. You should stop putting any more money, good money after bad.
It's good. It's throwing good money after bad. I mean, the term I keep using is capitulation, right?
Right.
And what we have not seen in today's market is widespread capitulation from the operators. Well, and frankly, for the lenders, we'll get into that too.
Well, but that's what people ask us all the time. They say, what's different about this end of the cycle versus the last end of the cycle? And we mentioned it just a second ago. But to us, the big difference is it's not bad enough to make failure acceptable.
Right.
In 08 and 9 and 10, failure became acceptable. Not immediately, but when you started to look at the global impact, no one
wanted to fail in that period, but I think it became, to your point, everybody understood that failure was happening because there was a financial crisis. There was something, an external force that you could kind of ascribe to it. And so it became acceptable. And so capitulation happened. Now, at the time, it felt very slow, right? Well, actually, it felt quick and slow kind of at the same time, paradoxically. But I think in this market, because there's no widespread capitulation, it's onesie twosie, that is leaving some room for operators with bad deals to say, man, I just got to hold on a little bit longer and the market's going to turn and it's going to turn in my favor. When the truth is their deal is cooked.
Yeah. But there are, and that's the challenge, unlike 8, 9, 10, there are some deals that if you look at them today, and we've taken a look at a lot of them that have been brought to us, and we're looking at it and saying, hey, it's not worth what you think it's worth, but if you gave it to me for this, I think you could make some money later.
Yeah.
And I think there is definitely a case to be made for hang on as long as you can and do it on some deals, but no one, especially if you're in the forest, you can't see the forest for the trees, right? You want to hold on to your deal as long as possible. We don't have anything like that. We're very lucky. We came up with a strategy to try and avoid what's going on right now, which is how we know it was possible. We have not had a capital call. We have not had a deal go bad.
Nor do we have a capital call on the horizon.
No, nor currently on the horizon. And I think that's how we know this cycle somewhat could have been avoided. Right.
Well, that's the thing, right? I think, going back to why we did 2 episodes on the history is that, there was an irrational exuberance in this market, as there were in a lot of other markets and as there historically, right? But the truth is there were a lot here. That's why people were using floating rate bridge debt at high LTVs to buy deals that didn't pencil with traditional financing, even though you probably should have bought them with traditional financing.
And investors were clamoring for it.
And investors were calling and saying, no question, right?
Waiter, you just doubled my money. Right. Where's my next deal? And so everybody participated.
No question.
The operator should be blamed, but we're going to get to the other 2 parties as well.
Exactly right. But my point is you had this irrational exuberance and now you don't, right? We've come out of that period of the
market. And I think we've also seen, it's worth mentioning, some really bad behavior from operators.
Yes.
And we're going to touch on that a little bit too. Again, we're in an enviable position that we have not had these issues. So we don't want to come off as sour grapes against some people, because we know some people that have some challenges that we look up to that are amazing operators and owners. But we also have run into several that probably didn't have the expertise to grow the way they grew, that didn't have the expertise to execute the way they were trying to execute. And we, even 5 years ago at the time, were asking, how are they doing this? How is this happening? And now that we're starting to see some of the deals, and in some instances, these are very large groups that have had major struggles. When we're seeing the results of that, we're looking at it and saying, oh, that's how they did it. They held their nose and did deals that they probably
shouldn't have done. They shouldn't have done.
Yeah, and there was a lot of that.
There was. So I think it's important to parse between the 2 distinct groups that we're talking about, right?
Right.
We're talking about a great operator in many instances with 1 or 2 deals that just didn't work. And again, that can happen. That's happened to us.
Yeah.
And then you're talking about operators who I would say borderline fraudulent, if not outright fraud in some cases.
Yeah,
I'm thinking about, right?
It's a spectrum. It's not,
or they bought deals in a way that was never going to be sustainable, that was incredibly aggressive.
Well, we talk about this all the time. Andy and I have a personal belief that largely markets are not very good at judging risk. And so what we try to do at Arcan is be really good about judging the risk that we're taking. If you're taking out an 85% floating rate loan that resets every month based on interest rate, at the end of the cycle, you are taking a massive risk.
Right. And sometimes that risk pays off.
Oh, we've used it earlier in the cycle, but we got nervous about it because we started sensing, as everyone did, people are saying, oh, we just didn't think interest rates were going up. We were all talking about it for years, how they were about to go up. We actually got a longer reprieve from it than we thought.
Well, the truth is,
longer to go up.
It's really easy to, you look at an interest rate environment when the Fed is at 0 for an extended period of time, or near 0, or it's actually 0 to 25 bips. For a long time, goes up a little bit pre-pandemic, comes right back down to the pandemic. But the truth is, if you're sitting at 0% interest rates, there's only one direction you can go.
Right.
We're not Europe with negative real interest rates.
That's right. Right. So I think what we're saying is some of this happens at the end of the cycle no matter what, and some of the pain is deserved. Okay. Some of it is the music stopped and you got stuck without a chair, and that's bad luck and bad timing.
It's bad timing, yeah.
And a lot of it is also bad behavior. So we get asked this a lot by our investors, which is why we wanted to talk about it. Yeah, there's some bad behavior, and yeah, there were a lot of people making a lot of money that we don't really think knew what they were doing.
That's right.
And that comes off, I think, as a little arrogant, but we think we know what we're doing, or we wouldn't be doing it. And I think everybody thinks they know what they're doing when they're doing it. So ultimately, I think that kind of gets through the operators, right? And we have two more people to talk about, which the next group is the investors, okay? And we love investors. They're our absolute favorite people. So remember that if we may sound a little critical of you, please don't take it personally, because we are also investors. And we are also, we have some of our own bad deals.
We do have our own deals.
Andy and I are better at running an investment company than we are at investing in outside companies.
I think we're really great, Steve, at investing in multi, and I think it's a good reminder to everyone listening to this podcast. Steve and I invest personally in every single deal that Arcan does.
Yeah.
Right? So we're talking about investments outside of that sphere, where I think our record is a little more mixed.
It's not great. It's not great. But as investors, we want you guys to hear that we're investors too, because some of the stuff we're going to say, I think, may sound critical investors, and it's meant to be, because investors get caught up in the exuberance as well, as we have.
Well, I was going to say, exactly, this applies to us equally,
yeah,
right?
Absolutely. Absolutely. What's funny though is I think we got caught up in even in a little bit in investing outside of Arcan, but at Arcan, where it was our real main focus, we stayed very cautious. And I think did a really good job over the last cycle. We are very proud of what we accomplished over the last cycle.
Do you mean to tell me that opening a restaurant, Steve, was not the most financially savvy investment I've ever made?
Only made worse by the ones you convinced to invest.
That's exactly
like your friends sitting at the table.
That's exactly right.
No, but it's some of investing is fun. It's meant to be fun, as long as you remember that when it goes bad, they're supposed to. No one bats 1,000 on their investments. Even Arcan on real estate, we haven't batted 1,000. And sometimes you're
just 950.
Yeah, and sometimes you're getting hit by pitch to get on base. Sometimes you're getting a double. Sometimes you're hitting a home run. And the hope is that you put it all together as an investor and look up and go, "Wow, I actually did pretty well." And that's the one thing we would say.
I want to win the game after 9 innings, right?
And we think most investors did. If you put together your entire portfolio from 2010 to 2025. And you look at your overall return in just apartments, and you got something in the mid-teens annualized IRRs, you are a very good investor. But just because you had, even if 5 went bad, but 25 went well, you got to look at your whole portfolio. And we think what's funny is at the end of the cycle, investors are really hard on themselves and they get nervous very quickly. They probably get exuberant more slowly, but if you get a deal go bad.
Once there's a critical mass of that exuberance, though, it all just kind of flies, right?
Absolutely. And we see that a lot right now. So the same thing that happens when things are going really well, I think is happening when things are going poorly right now, is everyone's looking around going, "Oh my gosh, do they have bad deals too?" The answer is yes. Everyone's got a bad one. Yeah. Everyone's made a bad investment.
I believe they call that a spoiler alert?
Yes. You are not the only one with capital calls.
Yeah, that's right.
We promise. And I think the real things that are happening right now is investors are realizing maybe they invested in some people who they shouldn't have, and are reassessing that, as we are, as investors.
Well, I think the lesson that I think you and I both have learned as investors, Steve, is outside of Arcan, you and I are not necessarily the best qualified at picking a specific investment. What we are good at is picking the group to invest with. Right?
Correct. Well, and that's what we would say. What we would say is, if you're going to look at something to buy, Andy and I, earlier in this cycle, did have some criticisms of investors because it felt like investors thought they could pick deals. And that's what we do for a living. We consider ourselves professionals at looking at an apartment project and saying, "I can make money by buying this at this price." And when your investors start coming to you and saying, "Yes, I'll take that one, but no, I won't take that one, but I'll take this one," we start to wonder if people are getting more exuberant because they think they can pick winners. And that's what we think we do for a profession. And it's hard enough when we live it every day. So I think that's one of the things that's gone on. Investors thought they could pick winners. And ultimately, even when we're investing, we start to remember, I'm investing with the operator. That's what I'm really investing.
That's the thing, right? And to be fair to investors too, I do think that in this period, from 16 onward and really turbocharged in 19, I think there were a lot of groups that were just putting tons of deals out there, even if they didn't think they were going to necessarily make money, because they wanted to make fees on the transactions, right?
Sure.
And I think that, that only underscores our point, which is it's the sponsor, it's the operator that really matters, less so than the deal. I mean, every deal has its own risk profile, right?
Sure. Yeah.
But if you have a sponsor like us, and again, I want to be a little humble about this, but we are not going to do a deal that we think is not going to make money just because we want the fees.
Our model's not set up that way.
Our model's not set up that way.
We say this all the time to our investors, and we say it here, If we do a deal and it doesn't result in as a successful investment,
then we're
the
not
juice is not worth the
exactly
squeeze.
right.
It is not worth running this company if our investments don't succeed.
And
that's good. You should know that, and you should know that about the people that you're investing with. And I also think all the investors, not dissimilar from operators and lenders right now, they're waiting for the right time to move.
Mm-hmm.
They're all looking around, saying, "When am I going to jump back in?" And the one thing we want to make sure that everybody else understands too is that don't be fooled. There's a ton of money out there. A lot of people have made a lot of money. That's how we know. If you look at your portfolio for the last 10 years, you'll feel better about yourself and probably be pretty happy, because we do think people made a lot of money in the last cycle. They're just feeling the pinch right now and are hoping that those pinches go away. But we think once those capital calls stop, you're going to see a lot of money come back into the system, which is part of why we think it's a good time to invest.
That's the thing. And what we're already seeing is some of what I'll term the smart money, some of the institutional capital has started to come back into the market. Now, there's still a gap between buyers and sellers on pricing. So that's slowing transaction volume significantly. But the transactions that are happening outside of, the select groups like Arcan that we're seeing are major institutions coming and saying, hey, we think this is a really great opportunity to start picking up excellent assets at discounted pricing. And so those are the transactions that we're actually seeing going through. And again, these very sophisticated investors with lots of capital behind them, they're not deploying it in a flood, Steve.
No.
But they are deploying.
No, but it's everyone's asking the question, are we at the bottom?
Everyone.
And we think we are. We're not trying to time it perfectly. Obviously, we would say, are we generally at the bottom versus are we generally at the top? And we think we're generally at a bottom. It's a good time to buy for good deals. Having said that, we also just mentioned that, and we're going to get to the lenders.
Yeah, I was going to say, let's talk to the lenders.
I want to be mindful of time here.
Yeah.
But the lenders are part of the challenge we're having right now, because to give you a fake example, we would love to buy this deal at $40 million from you, Mr. Lender, that you've taken back, but they think it's worth 41 or 42. And they're holding on to it. So what is happening with the lenders? Well, they may be the real bad guys. They were the ones that made some of these loans, right?
They were certainly, and I want to be careful because, again, just like operators, there are good lenders and there are not as good lenders, right? Yeah. And I think that there are some lenders that have gotten stuck with a lot of loans that they probably shouldn't have made, right? And in retrospect.
And they trusted borrowers that had really performed for them, just like investors did. Everyone is having the problem from the same.
Well, that's the thing, right? We're talking about 3 distinct groups, and each group had a part to play in what's going on right now, right?
And the lenders we always think of as the adults in the room, the ones that are going to stop us from being crazy and buying deals we shouldn't buy. But the reality is they're victims of the exuberance too.
They are, and they're also victims of competition, right? When you have a lot of debt funds out there that are throwing capital around, you've got to compete. And as a lender, your job is to produce.
Yeah, you cannot make money in this business. It's very transaction oriented. You cannot make money in this business by just sitting on your hands. You've got to be lending it. You've got to be investing it. You've got to be buying deals.
You got to be selling deals.
And you got to be selling deals. And so one of the pain points we're feeling right now in the environment is just low transaction volume. There's less money for lawyers to make. There's less money for accountants to make. Everybody likes tons of transactions. Brokers, you really want to have a ton of transactions, and lenders get that too. They've got to put money out.
Pressure's there for them.
They don't get bonuses for not lending.
That's right.
They get bonuses for lending and their deals getting paid back. So I think the most interesting thing to hit on of lenders is how they're very critical of borrowers sometimes and how we do things. And now that they're taking some deals back and seeing some of the pain, they're acting just like the borrowers, which is, my deal's worth a little more than you think it is. I can run this thing and I can just hang on. And a lot of loan officers that were employed to make loans are now being employed to manage the deals that are problematic, whether that's been foreclosed or in receivership or any of the other options, just working with the borrower to get to the end, because we are seeing a lot of borrowers who have a maturity coming up. They cannot
or have already passed,
or it's passed, and they cannot pay the loan back. And depending on the type of asset the lender is seeing, they may say, listen, we'll give you an extension so that we can talk about this next year. Just keep paying, we'll figure it out. And then in some instances, they can't keep paying. So they have to modify the loan and take that 8% interest rate down to 3%, which the operator can pay today, but then they'll start accruing some of that other interest. And that's a dangerous game because that accrual isn't going away.
It's not, and that also doesn't work for every deal. There are some deals that are, in CMBS or CLOs where the rules may prevent such an instance.
And that's one of your expertise, right? Is understanding how all those things are structured.
Right.
That it's not as easy as, well, just take it back, just do this.
It's much more complicated.
Operators can do whatever they want. We've got an operating agreement. As long as we follow the operating agreement, we can sell it, we can buy it, we can refinance it. But lenders may not be able to do some of the stuff that would make the most sense for them financially.
In fact, oftentimes they are unable to do that, right? So I think what you're seeing right now is lenders are debating and hesitating. Should I take back this asset? Should I try and sell it? What should I do? And to your point, I think we're seeing a lot of them turn into asset managers, which is not their primary job. And I think they're struggling a little bit with, strategically, even if they do turn into asset managers, how long do I hold this asset? What do I do with it? How do I get out and get par value on my loan, which I think is a very critical point that we're seeing.
That is a critical thing. I love that you said that, because operators want to make the most money possible, but lenders are capped. All the lender can get is the money they lent out plus their interest. So if you ask why lenders are so risk averse and why they're sometimes difficult, it's because they don't get the upside that everybody else gets. They either get all their interest and their money back, or they get less than that. Mm-hmm. They can't get more.
And we'll discuss this a little bit in the next episode, but one of the issues that we're seeing right now, particularly with lenders with high LTV loans on their books, the asset right now is not worth a lot of these loans. It's close in some instances.
Which is why they're hanging
on. But they're underwater on their loan. And, that's a tough realization. As a lender, that is kind of the worst thing, is to lose money as a lender. Because again, your job is not to do that. Your job is
well, let's contrast those. They're not looking at it like operators and investors.
They're not.
Operator investors know they're going to lose money sometimes.
Mm-hmm.
Lenders don't ever want to.
Ever.
Those numbers need to stay below 1%, right?
Mm-hmm. That's right.
And when they're underwriting them. So I think in summary, to wrap this up today and keep our time as we discussed, I think we would say, of all these players, everybody played a role in this, okay? And they're continuing to play the role. And if we had to come up with a theme, I think our theme would be everyone is just hanging on.
Nobody's taking their medicine.
Nobody wants to, because they're hoping something else will happen. The rates will come down. The world will be a better place. And it almost feels like there is either a thing that's going to come and happen that will make everybody jump back in, or more likely what we think is, and this is Andy's, I'll steal it. The dam's going to overflow and gradually people are going to jump.
Yeah, I think that's what's happening, right? I don't see some big external event like the Fed rate, lowering rates to zero again, that's going to bail everybody out of this mess. I don't think that's going to happen. So I think what you're going to see is, to my point that I've made a few times, it's a dam. All the deals are behind it, and it's just going to overflow consistently. It's not going to be a tsunami. It's just going to be kind of a trickle.
26 will be a little better than 25. Yeah. 27.
And eventually the market will work itself out. But I think for now, the point is, we think we're at a near-term low, and call that 12, 24 months. I don't know, right? We're not going to try and time it to that degree. But I think, as transactions happen, we'll kind of see at this price level, and, hopefully we'll pick up a little bit in volume come 26.
Yep. And we're going to keep talking about this even more.
Yeah.
Like I said, these are dense topics. So on the next episode, we're going to continue going down this road, only maybe with a little bit different of a twist, and say, okay, so what would you be investing in right now? How are you going to approach this? How do you avoid it in the future? And what kind of things?
Yeah. What is Arcan's strategy to attack this market?
So thank you for joining us for this. Again, we really appreciate all the support, and we'll be back to you with another one shortly.
Thanks, everybody.
Thank you.